Thanks for staying on with us on Niaga AWANI. My name is Ibrahim Sani, taking over from my colleagues Harits Asyraf Hasnan as well as Najib Aroff. It's a beautiful Monday morning and there's plenty in store for you this week, mostly on the second quarter GDP, not just of Malaysia but many other economies around the world. Also, corporate earnings is in the season and we're going to expect a lot of surprises as well as predictions coming in from many of the GLCs and MNCs in Malaysia. However, many economists have predicted that the recession is just around the corner, especially for advanced nations as the world sees unprecedented challenges from investment research firms to Bank of America all made the same call, saying that the GDP in the Eurozone to fall in both the third and fourth quarters of this year. A number of factors have combined to create a toxic mixture, and in response to the COVID pandemic, America overstimulated its economy, provoking inflation not just within its borders but beyond them as well. In the meantime, China's attempts to stamp out COVID compounded these problems, and then of course Russia's invasion of Ukraine caused commodity prices to soar even further. In response to this, the ensuing inflation, roughly 4/5 of the central banks worldwide have raised interest rates by an average of 1.5 percentage points, the recent being the BOE last week. So joining us this morning is IQI Holdings Chief Economist Shan Syed. Good morning, Shan. Let's talk a little bit more about the recession possibly having to arrive in North America, Europe and the UK and many other countries. Inflation runs high in these regions and there is a growing discourse among policymakers to tame that inflation, induce recession and help the global economy. Do you think, Shan, that this novel idea in monetary policy can help reduce inflation over the next 6 to 12 months?
Ibrahim, there's a probability that 50% it can work out. So you have two side of the story. You have monetary policy and you have recession. And monetary policy has been more effective in taming inflation. But now, since, as you rightly mentioned, that inflation is rising high, the new strategy is to raise interest rate, bring recession, consumer sentiments and down, and ultimately the prices will come down. I don't know how it will pan out, but I say there will be a lot of pain, especially in the advanced economies, if they go through this cycle, which is not easy. But historically speaking, it has always been monetary policy that has been able to control inflation globally. So I think if central banks, they go through this route of monetary policy and they raise the interest rate, inflation will not be controlled overnight, not in 1 month, maybe in 15 to 18 months. It's a long cycle, but inflation will stay globally for the next 12 to 24 months. So I don't know how the induced recession is going to control inflation, because the caveat is that oil prices will run high, not only this year but also for next year, and how they are going to control it when you have higher oil prices. I would not be surprised if central banks they keep raising their rates next year as well.
You have mentioned in your newsletter in April this year about stagflation hitting the US, recession as well as quantitative easing. Many commentators are talking about the 1982 high yields in the bond market. Has the world moved from 1970 to 1982, or are we stuck in an era of the 1970s stagflation, a repeat of sorts, so to speak?
If you ask me, I am still stuck in 1970, because 2/5 of the global economy is still in stagflation. And yes, the bond market has recovered in the last 17 months. I still remember Warren Buffett made a statement in Financial Times on 27 February that bond is the worst asset class to be in. But right now, if you see, the yields in the bond market have gone up on the average 4%. And most of those investors are looking at, they're hunting for yields. So I think bond market is back and global investors will continue to take long-term position. If you pick up Bank of America's report last week, there's a lot of interest, especially among advanced economies investors who are taking long-term position. They feel that interest rate will continue to go up this year. So bond is the asset class to be in. And right now, if you want to understand what is happening in the market right now, you just follow the debt market. If you follow the debt market, it can give you forward guidance on recession, on yields, on housing market, on commodities, on equities. So I think debt market has given a lot of forward guidance to these investors. I still recall in December 2020, $18 trillion of global bonds were trading in negative. And right now, when I speak, $2.5 trillion of bonds are trading in negative. So I think bond market has really recovered. And I think this is the best asset class to be in. 1982, 1970, I still feel that some investors have moved to 1982, but I'm still stuck in 1970. I think we are here for a long haul.
Where do you see the Fed interest rates heading in this, September, November, and December? We've seen how Jerome Powell has indicated that he's not ruling out another interest rate hike, but depends on the data from now until then. Do you think that markets have priced in, or do you believe that there's a halt in the rate hike rate between the big four central banks of the world?
Yes, absolutely, Ibrahim. The way the big four central banks are moving, I think by September, all the banks are saying Bank of America, JP Morgan, Goldman Sachs, and we even at Joy IQI, 50 basis points will be raised in September. And in November, December, Fed will raise 25 basis point. At the start of the program, you mentioned that 4/5, 80 central banks globally have raised their rates, and the average rate has been 150 basis points. So I think we at Joy IQA continue to forecast that interest rates will be higher. And even BlackRock in their latest mid-year report, they are expecting that global central banks will continue to have higher interest rate regime, and there will be a lot of market volatility, and strategic allocation has to be more dynamic than before.
Coming to Malaysia, Bank Negara is doing a lot in terms of trying to tamp down the economy or cool down the economy. Do you think, or do you foresee rate hikes again in the upcoming MPC meeting in September? And what do you think on the GDP outlook for this second quarter and third quarter? Second quarter is coming up this week. What about third quarter?
I think Bank Negara will raise 25 basis point. That's it for this year. So we expect discount rate to be touching at 2.5%. Overall, I think Bank Negara is very cautious. They understand that they have to follow the mandate. They have maintained price stability. In June's issue of Economist magazine, they have given a clear picture of advanced economies and Asian economies. So advanced economies are having very high inflation as compared to Asian economies. They have included Malaysia as well, where inflation is still very low as compared to many economies in the region. So I think Bank Negara has done a pretty good job in taming inflation. At the same time, they have maintained growth stability, which is very important, and structural stability in ringgit. As far as GDP is concerned for this year, we expect Malaysia's GDP to be hovering between 4 and 5%, and we continue to maintain this stance for the rest of the year.
Thank you very much. That was Shan Syed, IQI Holdings Chief Economist, joining us live in Kuala Lumpur. We now move on to some international news. The Senate has approved Democrats' big election year economic package, and the legislation is less ambitious than President Joe Biden's original domestic goals. But it embodies deep-rooted party dreams of slowing global economy, moderating pharmaceutical costs, and taxing big corporations. Debate began Saturday and went around the clock on to Sunday afternoon in the US, and Democrats have swatted down some 3 dozen Republicans' efforts to torpedo the legislation. Cheers broke out as Senate Democrats held united 51-50, with VP Kamala Harris casting the tie-breaking vote after an all-night session. President Biden urged swift House passage. The House seems to be on track to provide final congressional approval when it returns briefly from the summer recess on Friday. Inspection of grain ships headed to and from Ukraine continued over the weekend as footage released by the Turkish Defense Ministry on Sunday showed an extensive check on the grain carrier Navy Star on Saturday. The Panama-flagged Navy Star, which is carrying 33,000 tons of grain to Ireland, left Odessa in the Ukraine on Friday. The Turkish Defense Ministry tweeted that it would be inspected by the Joint Coordination Center ran by the officials from Ukraine, Russia, Turkey, as well as from the United Nations. The checks seek to ensure that the outbound cargo ships carry only grain, fertilizer or food and not any other commodities, and that the inbound ships are not carrying weapons. The ships are from among a dozen of bulk carriers and cargo ships that had been loaded with grain and stuck at Ukrainian ports since the start of Russia's war in late February. While crossing the Black Sea, the ships followed agreed corridors to avoid naval mines that are accompanied by Ukrainian pilot ships. The head of the Russian delegation, Mikhail Ulyanov, present for talks aimed at reviving the 2015 nuclear deal between Iran and the world powers in a deal that is said to be imminent on Sunday. A new round of talks on the revival of a 2015 nuclear deal between Iran and world powers began recently in Vienna after a 150-day hiatus. Iran signed the nuclear deal, formerly known as the Joint Comprehensive Plan of Action, or JCPOA, with world powers in July 2015, agreeing to curb its nuclear program in return for the removal of sanctions on the country. However, former US President Donald Trump pulled Washington out of that agreement, and talks of reviving the JCPOA began in April last year in the Austrian capital of Vienna, but were suspended in March this year because of political differences between then Tehran's administration as well as Washington's administration.
I'm absolutely sincere. I cannot guarantee, but the impression is that we are moving in the right direction, and actually the number of unresolved issues is minimal, just 3, 4, and some of them are almost settled. The aim of negotiations is to restore.
And now we talk about some of the developments that is going to take place this week. It's going to be a busy week for Malaysia. This is because the second quarter GDP of Malaysia is out this Friday. Bloomberg estimates 5% year-on-year, and we're looking at about 5% continuation of this quarter versus last quarter. Also, we're looking at the developments of how Malaysia is going to be compared against some of the economies in this region, notably from Vietnam as well as Indonesia as the two manufacturing powerhouses in the region. Also, we need to look at some of the developments that is coming in from Singapore as well because of the services sector booming yet again. And Singapore is reopening its economy quite extensively. Now, everybody around the world can now fly into Singapore. And Singapore will become the next powerhouse yet again in the region. And how will Malaysia compare against that as well? That is the area that we need to look at for this week. In the meantime, G20 countries is also set to release the second quarter GDP as well. Again, same set of eyes are on the G20 countries, but because of some estimations of increased inflation rate in some G20 countries, most notably the UK as well as the US, how will that compare against the GDP growth for the second quarter of this year against all these countries? The BOE in its rate hike last week did say that the estimation of the inflation rate could go as high as 13%. And how will this 13% inflation rate take a damper on the economic growth for that country? Also, we're looking at gas prices shooting up quite extensively. That is a big problem for the US domestic economy, largely because of the inflation rate that is going there as well. So all eyes are on G20 countries as well as the US in particular and the UK for the second quarter GDP announcement for this week. Finally, some other areas of interest for us is that there will be a slew of corporate earnings that is going to be announced this week following their second quarter performance of the calendar year of 2022. We need to look at how they are going to react towards some of the expectations by analysts in terms of this corporation. Now, of course, at 9:55 a.m., we're looking at the FTSE Bursa Malaysia KLCI hitting about 1,501 points. We saw the close of 1,501 close last Friday. The benchmark index opened at 0.03 of a point easier at 1,501 points. On the broader market, losers inched past gainers at 131 versus 112, while 181 counters remain unchanged. In the meantime, Asian share markets made a stuttering start this morning, and the dollar held firm against a stunning US payrolls report, pushed back against talk of recession, but also bolstered the case of more super-sized rate hike. We just talked to Shan Said earlier, and he does expect a rate hike of quite an astronomical amount following the Fed movements over the past two MPC meetings there. Finally, on the issue of oil, Oil fell off this week's trading as the week trading kicked off, extending the biggest weekly decline since April this year. Amid persistent concern of weakening demand, WTI dropped $88 a barrel in early Asian trading after slumping by almost 10% last week on soft US gasoline consumption data. More details on the oil prices will be expected to come soon, considering that the war in Ukraine is being managed in a way by the opening of the grain trade as well. Finally, the ringgit opened lower versus the US dollar on Monday as the greenback continued to strengthen its appeal as a safe haven currency amidst a risk-off sentiment in the market. Plenty of market news for you this week. I wish you all the best for the week on Monday, and I'm stuttering. My friends are now laughing at me. But anyway, have a good Monday and have a good week ahead. My name is Ibrahim Sani. Catch you in the next one.